Bill talks taxes. He has been for over 45 years, and there isn't a human on the planet with more experience solving problems on behalf of taxpayers. He wants to solve your problem, whether you know you have one or not. So if you do have a current tax problem, call the office or visit TaxHelpOnline.com. If you don't have a current tax problem, then your current tax problem is taxes themselves. So let's get into the policy issues of today. Now that we're past tax season, people who actually do owe money expect to happen.
What happens when you file a tax return without the money? The IRS assesses the tax liability and then they go into collection mode. Now, they don't go into collection mode immediately, right? What happens is they send you an initial notice and it says, hey, maybe you forgot. Maybe you didn't realize you owe us some money and we want the money. And what they do is they give you a date in this initial notice. And it says, if you don't pay up by X date, then we can move on from there, turn down the screws, as it were. And so people think they have to pay by that particular date or the IRS can levy and seize bank accounts, and that's not true. The IRS goes through a whole series of initial notices before they send the final notice. But you need to understand that every day that the tax liability is delinquent, the IRS adds interest and penalties to the bill. The sooner you can pay it, obviously, the better off you are.
So can the IRS show up and levy a paycheck or a bank account just out of the blue?
Well, they can't do it out of the blue. No way they can do it out of the blue. Before they can levy a paycheck or a bank account, they have to send a final notice of intent to levy. Now, here's kind of how the sequence works. You are delinquent. The IRS mails you a notice that says, as I said a minute ago, you're delinquent, you owe us money. All right. And then there's a series of additional letters, CP 501, CP 503. These are notices, these are formal notices. If you look at the upper right-hand corner of the letter you get from the IRS, it'll tell you what the CP notice is. The CP 501 and the CP 504, CP 501 and CP 503 are the two preliminary collection notices that they use. And the CP 501 has, relatively benign language. The CP 503 gets a little bit more coarse and not abrasive, but forceful is really the right word. It gets more forceful in the language. All right. And those letters come, about, 8-10 weeks apart or so. And then you get a third letter, CP 504. That's a notice to levy a state tax refund. People confuse that letter for a general levy notice. It is not a general levy notice. If you read the CP 504 very carefully, you will find that the IRS can only levy a state tax refund per that notice. Now, the notice does say, quote, we will begin to look for other assets, unquote. And that's true. They will look for other assets, but they can't levy an income stream or a bank account or an automobile until they send the final notice of intent to levy. Now, a final notice of intent to levy takes a number of different forms, but the language is very clear, and it says final notice, notice of intent to levy, notice of your right to a hearing. They cannot levy so much as a postage stamp from an individual or a business for that matter until they mail out that final notice. The notice gives the taxpayer a 30-day window, all right? So the letter says pay up in 30 days or else. The or else is you have the opportunity to file an appeal called a collection due process appeal. That's a request for a collection due process hearing, and if you file that within 30 days, then that shuts down all collection while your case is considered by the appeals office. We can talk about that in a minute as well. But it's that final notice letter, Josh, that's so important because the IRS can't levy or seize anything until the final notice letter is issued.
What's the difference between a levy and a lien?
That is a good question. A levy is the process the IRS uses to actually take somebody's property and convert it to the ownership of the government, right? So if the IRS issues a levy on your bank account, they take all the money that's in your bank account, they apply it to your delinquent tax debt. If the IRS levies your paycheck, they actually intercept your paycheck, stand in your shoes, and they take your money from your employer instead of you getting your money from your employer. Same way with a Social Security account, same way with an independent contractor stream of payment. All of those levy processes actually take your money, your property, and give it to the IRS. A lien, on the other hand, does not do that. People confuse liens and levies all the time, but they're not the same. A lien does not transfer title of the asset from the taxpayer to the government. All the lien does, and it's significant. I'm not saying there's no impact with the lien, there is. But what the lien does is it puts the public on notice that the IRS claims an interest in your property, right? It becomes a security declaration. So when the IRS files a lien with the county recorder's office, goes on the title to your property, really goes on the title of property, at that point in time, you are restricted in how you can dispose of that property with a sale or transfer, because at that point, the lien follows the property. So it becomes a security interest that the IRS claims in your property, but it does not transfer title of the property from you to the IRS.
Do tax liens mess up your credit?
Well, they certainly can mess up your credit, because if you've got let's say you own a home and you're trying to refinance. Well, the finance company is obviously going to do a title search, right, to find out if there's any claims, and the lien will show up on the title to the house. Now, the lien does not show up necessarily on your credit report. The IRS does not report the tax lien to the credit reporting agencies, so it generally does not automatically show up on your credit report. Now, back in the old days, Josh, they did that all the time, right? So as soon as they filed a tax lien, they'd report it to the big three credit reporting agencies. The lien showed up on your credit score, and everybody knew you had a tax lien. All right, doesn't work that way anymore. However, it can be reported by third parties. So, for example, if the lien shows up on the title report to your house in the process of trying to refinance your home, then it might show up on the credit report as well. So it definitely can screw up your credit. There's no doubt about that.
So what are some steps that people can take to get ahead of this problem in general if they have a tax problem?
All right, first thing you got to do is figure out where you're at on the spectrum of ability to pay. All right, if you owe a relatively small amount of money and you can pay in a relatively short period of time, then I would recommend you work to set up an installment agreement to do that. All right, you can set up an installment agreement either by submitting IRS Form 9465. Form 9465 is called an installment agreement request. That will set the wheels in motion to get you set up on an installment agreement. If you can also do this online, the IRS has a link on its website, irs.gov, where you can set up an installment agreement if you owe under $50,000. All right, so in the case of owing less than $50,000, the best way to set up the installment agreement, use that Form 9465 or go on the IRS's website. Now, in order to make that work, you got to be able to pay that 50 grand within 72 months. All right, so if you owe more than $50,000 or you can't pay within 72 months, then you got to do something different. Then you can still make an application for an installment agreement, but now the IRS is going to want financial information. They're not going to simply automatically set up the installment agreement. They're going to require financial information, and there's a specific process for providing financial information to the IRS. We can talk about that if you want, but there is a specific process for doing that.
Yeah, what is that specific process?
All right, so in order to get that set up, now assuming you owe more than $50,000, or if you owe less than $50,000, you can't pay in 72 months. In that case, the IRS wants financial information. The way you submit financial information is you get IRS Form 433A for Alpha or 433F for Foxtrot. Both of those forms are financial statements. The A is a little bit longer, the F's a little bit shorter. If you're just a wage earner with a very simple financial situation, you can use the F. If it's a little bit more complicated situation, you got investment accounts, retirement accounts, you own real estate, you've got a small business, that sort of thing, then you'd use the A. In either case, you're providing information to the IRS that shows income and expenses and assets and liabilities. All right. And so based on the income and expenses, the IRS determines what your disposable income is. Disposable income is the difference between your take-home pay and all of your necessary living expenses, right? Food, clothing, medical care, health insurance, current taxes, of course, are on the list. All of that stuff figures into determining your ability to pay. So, for example, suppose you got $6,000 a month coming into your household and your monthly living expenses are $5,800 a month. These are all necessary living expenses. We're not talking about discretionary type spending like funding a retirement account or making the boat payment, right? Making the payment on your nice cabin cruiser boat. Those things generally don't count. We're talking about necessary living expenses. So if you got $6,000 coming into the household and you got $5,800 going out, your ability to pay is $200. At that point, the ability to pay becomes the amount of the installment payment that the IRS expects from you. So even if you owe more than $50,000, you can set up an installment agreement for $200 a month if your financial statement supports the fact that that's all you can pay. Right? On the other hand, if the financial statement shows you can pay $1,200 a month, that's what the IRS is going to want. If you owe less than $50,000 and you can't pay in 72 months, then again, that disposable income is the amount that the IRS will expect you to pay. You might have disposable income of $10,000 a month. You got $30, and this, this is possible. You got $30,000 of income coming in every month. You got $20,000 of expenses going out. This gives you $10,000 a month in disposable income. But if you only owe the IRS 40 grand, they don't expect you to pay 10 grand a month. They expect you to pay enough to get the liability resolved in 72 months. All right, now that's income and expenses. The other question is assets and liabilities. All right, if you owe the IRS $30,000 and you can pay within 72 months, they don't even care about how much equity you have in your assets. All right, you could have $1 million in a retirement account and they wouldn't expect you to tap that money as long as you can pay the liability in that 72-month period of time. But if you can't pay within 72 months and you got a bunch of equity in a house, a retirement plan, an investment account, whatever, they're going to expect you to liquidate that equity to pay down the liability as much as you can, and then go on to an installment agreement from there. So the IRS is not going to act like a bank in a big dollar case if you've got the money somewhere in some kind of asset to be able to pay the bill. They expect you to liquidate that asset to pay the bill unless there's unusual circumstances. So if liquidation of the asset would cause a hardship, for example, or if you simply don't have the ability to liquidate the asset. I'll give you an example. Suppose you got a elderly couple, 70, 75 years of age, on fixed Social Security income. They owe $200,000 to the IRS, and they've got $200,000 equity in their house. Well, if they sell the house, all the equity goes to the IRS, and now they have no house, right? And so that obviously would create a hardship. If they can't borrow the equity in the house because they don't have the income to be able to make the payment to the bank. So they can't liquidate the equity because they can't replace their living quarters, and they can't borrow the money because they can't service the debt. So in that situation, the IRS will not require that the equity be liquidated, but the taxpayer has the burden of proof to show hardship or the inability to borrow. So income and expenses, assets and liabilities are the factors that have to be evaluated in setting up an installment agreement that would be long-term.
So you mentioned multiple times that the taxpayer has the burden of proof. What if they can prove they have no capacity to pay whatsoever?
Yeah, that's a good question too. And so now in that situation, that is going to give rise to what we call an offer in compromise. The offer in compromise is the IRS's flagship settlement program. All right. This is the program that allows the IRS to accept less than full payment of the tax liability in resolution of the case. So for example, take that elderly couple that we just talked about. All right, let's just say they're an elderly couple and they have no equity in assets, right? They've got no, and you don't even need to be elderly to have no equity in assets. I mean, you could be 45 years old and have no equity in assets.
Let's take a pause and be realistic. Most people my age have no equity in assets at this point in time.
Well, that's true, but you'd be surprised at how many people over 50 years of age or 60 years of age have no equity in assets. It is just simply not that uncommon. All right.
Right.
So let's just take a 60-year-old guy, husband and wife, kids are out of the house. They're making, let's say, $6,500 a month between the two of them, and they have no equity in any assets. Maybe they own a house, but they don't have any equity in the house. Maybe they own a car, but there might be upside down in the car. Maybe they have a retirement plan, but there's just a few dollars in it. All right. Let's say $4,000 or $5,000. All right. So we're talking about very, very minimal equity in assets. In a situation where you got a husband and wife that are making about $6,500 a month, by the time you look at their necessary living expenses, all right, food, clothing, medical insurance, out-of-pocket health care, current taxes on the list, paying their car payment, all of these things that are necessary, right? That couple is probably going to have very little to no disposable income. All right, based on what I know, the financial picture is of a husband and wife like that, they're going to have next to no disposable income. So let's just say it's $100 a month disposable income. All right, let's say they owe $100,000. There's no way $100 a month is going to amortize a $100,000 tax liability over time. It's just not enough. When you figure in the interest and penalties, these people are just going to make payments over time and owe more when they're dead than they did when they started, right? So that payment situation is not going to fix the problem. If they have no equity and assets and very little ability to pay over time or no ability to pay over time, then they qualify for an offer in compromise. So if they owe 100 grand, I'm going to take their financial picture. I'm going to break that down. I'm going to fill out the financial statements that the IRS wants, provide the supporting documents that the IRS needs, and we'll negotiate an offer in compromise for that kind of a financial profile, in the range of 3 to 5, maybe $8,000 is what it'll take to resolve that. So we got $100,000 tax liability that we can settle for, let's just call it $5,000 to $10,000, maybe less than that, maybe even less than that. If that couple has no disposable income, right? Let's say they got $5,000 a month coming in and their monthly living expenses are right at five or even greater than $5,000 a month, and they've got zero capacity to make a payment. In a situation like that, where there's no capacity to make a payment and no equity and assets, we could settle that case for $500 or $1,000, maybe $1,500 flat fee to get it resolved. And I don't care if you owe $100,000 or $1,000,000, we
Well,
can get an offer in compromise resolved like that. Now, actually, there's 4 different offers in compromise, Josh, and this is where the vast majority of the so-called tax resolution firms out there do not understand. Right? Most of the tax resolution firms that you see advertised someplace try to cram people into this offer in compromise based on doubt as to collectability. This is the offer that I just explained. I don't have the money to pay. I don't have the ability to make a payment. I don't have equity and assets. So let's settle for, 3, 4, 8, 10 cents on the dollar. That's a settlement program that is real and exists, but not everybody qualifies for it. But there's 4 different offer and compromise programs, not one, not two, 4 of them. You got the offer and compromise based on doubt as to liability, which says, "Hey, I don't owe the tax." In fact, I just got a client's case resolved, Josh. This guy owed about $150,000 on 2 tax years, 2011 and 2013, where the IRS messed up the audit and my client's prior representative messed up the appeal. All right, so we had 2 mistakes that were made. The auditor didn't consider the proper documentation for my client's deductions, which he was entitled to, and his prior tax professional did not know how to appeal that decision. So 2 mistakes, and this guy's got $150,000 tax liability assessed against him. He comes to me. I submit an offer in compromise based on doubt as to liability. I prove to the IRS that the guy doesn't owe the tax, provided all the necessary supporting documents that the first auditor disregarded. So we provided it all again with supplemental information. We were able to reduce that guy's tax liability to about $8,500. It went from $150,000 to $8,500, not $85,000, $8,500. Now, this is a guy, Josh, that had enough equity in his house to be able to full pay that 150 grand. So there was no way an offer in compromise based on doubt as to collectability was going to work. He had the equity and the assets. The IRS would have said, we decline your offer because you can full pay. But that's not the approach I took. I proved that he didn't owe the money. All right, so you got the offer in compromise based on doubt as to liability, the offer in compromise based on doubt as to collectability. This is the one that says, yes, I owe the money. I agree that I owe the money, but I can't pay it. I don't have the ability to pay. All right, so then you got an offer in compromise based on special circumstances. And this is an offer that says, yeah, I can't pay the money, but even the amount of money that the IRS would expect to get from me based on the typical evaluation criteria, that's going to cause a hardship. So take an example. Somebody owes $200,000 to the IRS. They don't have any ability to make a payment over time, but they got 50 grand equity in their house. Normally, the IRS wants the $50,000 to settle the debt. Well, if you owe 200 grand to the IRS and you can settle for 50,000, that's not such a bad deal, except if the 50,000 would cause a hardship. So I had a client years ago. Her only income was from child support. So she had herself and her minor child. She had no disposable income, but she did have about 70 grand equity in the house. She owed the IRS 600,000. But we couldn't get to the 70 grand because she couldn't sell the house, because then there was no way to provide housing for her minor child. She couldn't borrow the money for exactly the reasons I talked about earlier. She didn't have the ability to service the debt. So I went in there with a special circumstances offer of $5,000 and the IRS accepted it. All right. So she had a $600,000 tax debt. She had 70 grand equity in her house, and we were still able to settle the case for $5,000 based on special circumstances. And then you got an offer in compromise based on what's called effective tax administration. And this is a very technical situation that arises when the taxpayer does owe the money and can pay the money, but full payment would cause hardship, that is to say, the inability to pay necessary living expenses, or there are some public policy considerations at stake. There's some fundamental unfairness that's involved in the tax. I had a client years ago that had that had their IRA money, about $300,000, stolen from them by a con man. All right, so this con man pitched them on this alternative IRA plan, and all you got to do is roll the money from this account to that account, and the new account's a qualified IRA account, so you're not going to have any taxes on a distribution. Well, Josh, the new account wasn't a qualified IRA account. The new account was this con man's bank account. He stole the money and he ran, and as a matter of fact, he did this to a couple dozen people. All right, so now what we have here is an actual distribution from an IRA. Well, IRA distributions are taxable, right? So my client lost their $300,000 to the criminal, and they had a tax liability of about 120 or so thousand based on the distribution. So they got the double whammy. They lost the IRA and they had the tax liability they couldn't pay. Well, this is a special that they were assessed. The problem is they could pay it, right? So this is where the offer in compromise based on effective tax administration comes into play. I proved that they were a victim of a criminal act. And as a result of that, shouldn't have to pay that 120 grand. So you got the offer in compromise based on doubt as to liability, offer in compromise based on doubt as to collectability, offer in compromise based on special circumstances, and the offer in compromise based on effective tax administration. That's the full picture of the offer and compromise programs that are available. You need to know how these things work to give yourself the best chance of resolving a delinquent tax debt.
And just brag a little bit, what are some of the highest tax bills that you got for offering compromise passed through for the lowest amounts of money?
Well, the single highest one was about $7 million that we settled for about 50 grand. But we've also settled, $200,000 and $300,000 tax liabilities for $500 and $1,000. It's not that unusual. But here's what people need to understand, and this is where ignorant folks, uninformed people, get in trouble with the advertising that's out there, where these firms say, we can get your offer and compromise settled for 10 cents on the dollar. All right. There's no magic formula for a settlement amount. All right. The IRS's rules don't say 10 cents on the dollar or 15 cents on the dollar or 50 cents on the dollar. There's no formula in the IRS's procedural manuals that establish that rule. It does not exist. The settlement for offer and compromise based on doubt as to liability, how much do you owe? All right. The question is, how much do you owe? I proved that my clients don't owe the 130 grand. They really owed about 8,500 bucks. We settled for what they owe. All right. When it's an offer and compromise based on doubt as to collectability, the question is not 5 cents or 10 cents on the dollar. The question is, what is your ability to pay? All right. And this is where we evaluate income and expenses and assets and liabilities. When you submit an offer and compromise based on doubt as to collectability, I can just about guarantee you that the first response you're going to get from the IRS is, you can full pay the tax. All right, we disallow this expense, we disallow that expense. Your house is worth $3 million. Your mortgage is not $100,000, it's only 10. In other words, they misread everything, Josh. These offer evaluators misread everything. All right. And so what you need to know is how to respond to these people that are misreading everything. You need to know what the IRS's rules are for evaluating income and expenses and assets and liabilities. They got a whole manual that sets up how to do that. And I promise you, their people don't read it. So I have to read it to understand it, to make sure that I can point out the mistakes they're making. And then the other thing you got to understand is you have a right to appeal. Their decisions are not final. People get intimidated. They get ground down by the process. They get frustrated talking to these to offer examiners that don't seem to understand the facts. So you have to be willing to appeal it to get yourself to the IRS's Office of Appeals. And the appeals officer's written job description is to negotiate a reasonable settlement. And that's where you want to be.
Well, it sounds to me like the benefit to having a very large tax debt would be if you're entirely broke, then you can just say you can't pay it.
Well, here's the thing, Josh. This is the reality. It's a good news, bad news situation when you're dealing with somebody who's broke that owes the IRS a lot of money. And I'll suggest this to folks. I talk to people all the time. I'll say, well, we need to do an offer in compromise. We need to make a settlement offer to the IRS. And people will hold their heads. But Dan, I don't have anything. I'm broke. And I'll say, well, that's a good news, bad news situation. The bad news is you're broke. The good news is you're broke. If you're broke, they can't get anything from you.
Can't
And
milk a
and
rock.
here and here's the reality. The fact of the matter is the more money you owe, the more likely it is the IRS is going to negotiate a settlement if you have limited income and no substantial equity in assets. Because here's why. Here's why, and this is another significant misunderstanding that the public embraces. And when they find out the truth of this, it's like getting let out of jail. People think that the IRS can chase you for the rest of your life to collect a delinquent tax debt, and that's simply not true. People also think that even after you die, the IRS can chase your family for the delinquent tax debt, and that's certainly not true. The IRS can collect the debt only from the person who owes it. All right. So if you owe a tax debt, they can't come to your brother to collect the money. They can't come to your mother or father to collect the money. They can only collect it from you or your assets. All right. So that's number one. Number two, there is a rule of law called the collection statute of limitations. All right. The collection statute of limitations fixes the time in which the IRS has to collect the tax. They only have 10 years from the date of the assessment in which to collect the tax. Now, the tax becomes assessed when it's recorded on the IRS's books as an official liability. All right, that date is recorded in the IRS's accounting systems, and we have access to those accounting systems, and we can get the debt. So if somebody owes, let's say somebody owes a tax debt from 2013, they say to me, Dan, I owe this tax liability from 2013, and the IRS, it's 150,000, and how am I ever going to fix this? The first thing I do is look at the collection statute of limitations. All right, I get the assessment documents from the IRS. I ascertain the assessment date, and then I compute when that 10-year period of time runs out. And it may well be that if the taxpayer, we're talking about 2013 as my example here, if they filed their tax return on time in 2014 and there are no events that occurred that would stop that statute from running, there's about 8 or 10 things that people can do to stop the statute from running, and people don't know what any of them are. All right, I've got them all documented in my book, How to Get Tax Amnesty. I document all of them. But let's just say you didn't do anything to stop the statute, which is not that uncommon. Most people don't necessarily stop the statute. So we're talking 10 years. So if the IRS assessed the tax liability in June of 2014, well, here we are, April of 2025, that statute of limitations might well have run. All right. That person might be just a simple letter away from fixing their tax problem without even having to file an offer in compromise. But the point is this, that when the IRS is 4 or 5 or 6 years into that statute of limitations, their ability to collect narrows, right? That window narrows. And so now it's even less likely that the person will be able to pay the debt over time. So all of these factors come to bear on the ability to negotiate a settlement with the IRS based on your financial situation.
So time is really on your side with
Yeah, it really
this,
is.
with
It
this
really
kind
is.
of thing.
Now, if you've got a tax liability and you're only 1 year into the 10-year statute, you're not likely to be able to hold your breath for 9 years and just wait for the IRS to go away. For one thing, they got so much time to collect that they're not likely to just go away.
So
But if you're nine years,
you can't just shred the letters for 9 years and hope that
no,
what's to stop someone from doing something like that?
well, you can shred the letters all you want, but at some point in time, which I don't recommend, by the way, at some point in time, the IRS will go into enforced collection mode. All right. So if you've got an income stream, they'll intercept that income stream. They'll use wage levies. They'll use independent contractor payment source levies. They'll use a social security levy. They'll use a pension levy, right? So they can intercept that income stream. So you can't, when you have that income stream, you can't just ignore them. I will say this, however, If you're 9 years into the statute of limitations, you're 9 years into that 10-year statute of limitations, it might be possible to hold the IRS at arm's length for the rest of for another year until it does go away. I will say this, during the COVID period, and we're still seeing this now, even though it's 2025 and we're, good 3 years away from removed from the, the heart of the COVID period. The IRS really left people alone for the most part, right? Both from the standpoint of audit and collection, they were more or less hands off. Not completely, but more or less.
People
And
can only deal with one plague at a time.
one plague at a time. And so I can't tell you how many people had their tax liabilities just expire under my watch, all right? Because the IRS just wasn't doing anything. And so my attitude in a lot of cases was, look, you're only 7 months away from the statute running out, 10, 12, 14 months away. Let's see if it runs out. They're not doing anything. Let's us not do anything. And let's just see if they go away. And a great number of tax liabilities evaporated because of the collection statute of limitations. And there are probably people out there right now that are listening to this video that think they've got a tax debt hanging over their head that might well have expired because of the collection statute of limitations.
So I got a couple of questions based on that. The first one being, if you file your taxes and you don't pay them, how long does it take them to kick in with letters and notice that they're missing money?
Yeah, that's a good question too. The first letter is called an adjustment notice. That's a CP14 notice. And that's going to come roughly 6 to 8 weeks after you file the tax return. And that letter is going to say, hey, we've adjusted your account. You used to owe $0 for, let's say, 2024. Now you owe 10,000. And that letter gives you a date. This is the one I alluded to earlier. That letter gives you a date. It says, pay this amount by X date. Now, if you don't pay by X date, that doesn't mean the IRS can levy and seize. It means that the interest starts running again. So in other words, the amount they give you has interest computed through X date. On X plus 1, you owe more money. X plus 2, you owe more yet, and so on and so on. It's not until they send the final notice letter, final notice of intent to levy, and notice of your right to a hearing that they can actually enforce collection. That could be as much as a year or two away from the filing of the tax return from that first notice CP14 letter that says we adjusted your account.
Okay, so the second question in the same vein is then, if you don't file at all, how long does it usually take them to notice and do a substitute for a return or whatever it is, the process that they do when they make up numbers and give them to you?
Yeah, first of all, that's exactly what a substitute for return is. If you don't file a return, they file a return for you based on available information, quote unquote available information. And what that means is some guy sits at his desk and scratches his chin and looks up at the stars and says, oh, Josh owes, well, let's see, he made, I don't know, $400,000 last year. And they put that number down on the tax return and they send you a bill, right? Normally, routinely, Josh, the substitute for returns, what they call an SFR, is based on income information. So if they have W-2s and 1099s that reported to the IRS by third parties, that's the base of the information they use. But they don't give you the benefit of any deductions, credits, exemptions, nothing. They give you married filing separately if you're married, the single person if you're not married, highest possible tax liability, right? So that's an SFR. Now your question was, how long does it take them to catch up? Well, that answer is arbitrary. All right. We don't know. Well, let me rephrase that and say there's no way to pin it down, because I've seen people get contacted by the IRS within 2 years after they were required to file a return and didn't. In fact, I just had a notice on my desk here the other day from a client who didn't file his 2022 tax return, and the IRS is now in his face and they want his 2022 tax return. All right. So that's only been,
3 years.
Due to be filed in April of 2023.
2.5 years, right.
So yeah, we're only talking 2 years. I've also seen clients, Josh, go 10 and 15 years without filing tax returns and have never been contacted by the IRS. And there's no rhyme or reason for it. All right. So it's completely arbitrary. Here's the problem with not filing a tax return. There's no statute of limitations on the IRS's right to assess a tax against you if you didn't file. Normally, the assessment statute of limitations is 3 years from the date the return is filed. So basically speaking, they've got 3 years from the date you file your return to audit that return and make an additional assessment. And if they don't do it within 3 years, they can't do it. But if no return was filed, they can go back 3 years, 6 years, 10 years. They could go back until, until Moses left Chicago to figure out to do an SFR against you. Policy wise, they generally don't go back more than 6 years, but they certainly can.
So they could if they wanted to make an example, but that actually answers my last question, which was if you don't have a return filed, what is the statute of limitations? Which you just described it as it's not. There is no statute of limitations until you file. The moral of the story is if you owe and you have no capacity to pay and you're really worried about that, file anyways, because A, then the statute will start. B, then you can worry about whether the offer in compromise is something you can do. And worst case scenario, you can put in for uncollectible.
Well, you're exactly right. And furthermore, I will say this: if you submit an offer in compromise and you've got delinquent tax returns within that 6-year look back window, they want those returns filed anyway. So we're not going to do an offer in compromise if somebody has the ability to pay. Whether you owe the IRS 50 grand or 100 grand or 150 grand, it just doesn't matter. If you can't pay them, you can't pay them. So put a 0 on it, right? You might as well just add a 0. It doesn't make any difference. What you got to do though is you got to be in compliance with delinquent tax returns, and you got to be making your estimated payments for the current year, which of course didn't work 2025 now. So the IRS expects you to get back on the beam, get back into compliance, and stay there while the offer in compromise is being worked through. And if the offer is accepted, part of the terms of the offer, you have to stay current with return filings and tax payments for the next 5 years, or they'll revoke the offer they accepted. So an essential part of offer in compromise management, let's say, is current compliance going forward.
All right, well, that's all we got for this week. Thanks for watching, taxpayers. And remember, there is no such thing as a hopeless tax case. And if you think yours is the exception, call the office or visit our website to get a hold of Dan here. He can help you see the daylight. And Dan, tell them where else they can follow along with your taxpayers' rights crusade.
Follow me at Pillow Talks Taxes. I'm primarily on TikTok, Facebook, Truth Social, and right here on YouTube. Make sure you subscribe, like, and share these videos, especially with your federal and state representatives. And if you've got a tax problem along the lines of what we've been talking about, you need my book, How to Get Tax Amnesty. It will help you resolve that tax debt. Go to my website, TaxHelpOnline.com. You buy the book, How to Get Tax Amnesty. You get a free 15-minute consultation directly and personally with me. So go to TaxHelpOnline.com right now.